In the most sophisticated trading rooms on Earth, artificial intelligence is rewriting the rules of hedge fund investing and quant trading in ways that are fundamentally reshaping who wins and who loses in global markets. This transformation is not happening at the margins anymore. It is central to how the largest hedge funds operate and compete. The funds that have mastered artificial intelligence are pulling away from competitors at breathtaking speed, and the performance gap is now so substantial that it raises an uncomfortable question: can hedge funds that do not embrace AI-driven strategies survive long-term? Hedge funds deploying AI-driven trading strategies reportedly outperformed their peers by an average of 12%, as per a 2024 report from the Securities and Exchange Commission. 12% annual outperformance does not sound extraordinary on the surface, but compounded over decades, it transforms ordinary returns into exceptional wealth. As per Bloomberg Intelligence, AI-driven quant strategies contributed over 40% of trading volumes in hedge funds in 2024, with the figure expected to increase in 2025 as funds refine their algorithms and adopt neural networks for real-time decision-making. The scale at which this is happening has fundamentally changed the composition of global trading volumes. Machine learning in hedge funds offers more persistent alpha than traditional quant investing because ML systems can decipher change and adapt time frames of measurements and price predictions to enhance alpha generation across different market environments. This is the critical insight that separates modern AI-driven hedge funds from traditional quantitative strategies. Machine learning systems do not simply follow predetermined rules. They learn and adapt. Each trade teaches the system something. Market conditions that worked yesterday might not work today, and AI systems adjust their strategies in response to this changing reality. The legend's doubling down on AI. The most telling indicator of where the hedge fund industry is heading is what the legendary fund managers themselves are doing. Point72's flagship fund returned approximately 17.5 to 18% in 2025, marking its fourth consecutive year of double-digit gains and significantly outpacing the industry's largest multi-strategy funds, with the firm's dedicated AI fund, Turion, delivering approximately 30% returns by riding the semiconductor scarcity thesis. Steve Cohen, who founded Point72, earned $3.4 billion in 2025, making him the world's highest-paid hedge fund manager. That figure translates to an income of over $9 million daily. What makes Cohen's performance particularly significant is that he accomplished this in a year when many of his largest competitors significantly underperformed. Ken Griffin's Citadel, which has historically dominated the rankings, saw its flagship Wellington fund return just 10.2% in 2025, while Englander's Millennium posted similar results at 10.5%. The performance gap between Cohen's Point72 and its competitors is not random. Point72's outperformance can be traced to several strategic bets, most notably its dedicated AI fund, Turion, which delivered approximately 30% returns by riding the semiconductor scarcity thesis. Cohen made a deliberate strategic decision to create a dedicated AI-focused investment vehicle and entrust it to a portfolio manager with conviction. The fund was expected to launch either late in 2024 or in early 2025 and would be managed by portfolio manager Eric Sanchez, drawing capital from external investors, Point72 employees, and Cohen himself. The most remarkable aspect of Cohen's AI strategy is the capital deployment. His hedge fund, Point72, disclosed a massive $2.8 billion move into major tech stocks, including $870 million in Taiwan Semiconductor, $510 million in NVIDIA, $492 million in Amazon, $487 million in Equinix, and $439 million in Broadcom. These were not small experimental positions. These were massive, conviction-level bets on AI infrastructure. The derivatives pricing revolution. One of the most striking applications of AI in quant trading is options and derivatives pricing, an area where neural networks have achieved performance that surpasses classical mathematical models. Deep learning models achieved a 64.3% reduction in mean absolute error compared to black skulls for options priced between 3 to 19 Brazilian reals, representing 43.41% of all Petrobras option transactions on B3, with the neural network successfully pricing contracts that black skulls severely undervalued. This is not theoretical research. This is production performance on real trading volume. Black skulls, the mathematical model taught in every finance school, was developed in the 1970s and has been the industry standard for options pricing for 50 years. Neural networks are outperforming it by more than 60% in specific scenarios. Top quant funds like Renaissance Technologies' Medallion Fund returned 30% in 2024, with the edge not being the models themselves, but rather knowing exactly when and where to deploy them and how to monetize the pricing advantage through volatility arbitrage, superior hedging, and speed arbitrage during market dislocations. The operational efficiency transformation, beyond trading performance, AI is transforming the operational economics of hedge fund management. Hedge funds integrating AI for risk assessment reduced portfolio drawdowns by 15%. As per a report by Deloitte, drawdowns, the peak to trove declines during market downturns, are the metric investors care most about because they determine who can stay invested and who gets forced to sell at the worst time. A Bain & Company study noted that AI adoption in hedge fund research reduced costs by an average of 18% in 2024. That cost reduction multiplied across hundreds of funds translates to billions of dollars annually. More importantly, the freed up capital does not disappear. It flows to investment strategies and improved client service. Cost efficiency is being achieved where AI costs are now reported at about half the price of a junior human analyst, according to some fund managers. The agentic AI frontier. The frontier of AI development in hedge funds is agentic AI systems capable of autonomous reasoning, strategy development, and execution. Quant funds like D. Shaw, Bridgewater, and Two Sigma and proprietary trading firms and market makers like Jane Street, Citadel Securities, and Hudson River Trading have been at the cutting edge of AI and machine learning for years. Bridgewater launched a $2 billion fund in the summer of 2024 that is run by machine learning, with the manager's CEO, Nirbar D, saying this year the strategy produces a unique alpha uncorrelated to what their humans do. This statement is profound. Uncorrelated alpha means the returns generated by the AI system have nothing to do with traditional market factors. They represent genuine artificial intelligence edge. Balyasny, a $29 billion hedge fund, has built an AI bot that it believes will be able to do the grunt work that typically falls to senior analysts, with roughly 80% of the firm's staff using its AI tools, which include the internal chatbot BM ChatGPT. When 80% of staff are using internal AI tools, that represents a fundamental reshaping of how the fund operates internally. The performance proving grounds, real returns tell the story more powerfully than any theoretical analysis. Minotaur Global Opportunities uses 20 large language models to parse thousands of news articles daily and produce deep analysis, with their AI-driven research reportedly helping generate a 13.7% return in the first half of 2025, nearly double the MSCI All-Country World Index's 6.7% gain in the same period. Two Sigma achieved strong double-digit gains in 2024 using algorithm-driven strategies, with the Spectrum Fund returning 10.9% and Absolute Return Enhanced posting 14.3%. These are not speculative emerging funds. Two Sigma manages tens of billions of dollars and is among the most respected quant operations in the world. In 2025, several AI-driven hedge funds are already outperforming traditional quant firms, with the question investors now ask not being if AI will reshape investing, but how soon it will dominate the market. This represents a fundamental shift in how institutional investors think about hedge fund strategy selection. The skeptics and the resistors. Not every major figure in hedge funds has embraced AI-driven trading with enthusiasm. Citadel's Ken Griffin said at an October conference that AI cannot yet beat the markets. This is a remarkable statement from the founder of one of the world's largest hedge funds, particularly given that the data increasingly contradicts this position. Man Group's numeric unit has created an internal large language model-based workflow called AlphaGPT that still requires human oversight and strategic direction. This hybrid approach, combining AI with human oversight, has become the most widely adopted model among elite hedge funds. The resistance to full automation reflects genuine concerns about governance, compliance, and the unpredictability of black box AI systems. Financial regulators require that investment decisions be explainable, which traditional neural networks cannot provide. The hedge funds winning in 2025 have solved this problem through explainable AI frameworks and robust governance. Looking toward tomorrow, the trajectory is clear. Between 2026 and 2028, the biggest opportunities will come from three areas: alternative data rights, where firms that own exclusive access to niche data will hold an information edge; private market intelligence with AI tools analyzing startup financials and venture capital deals; and cross-asset agentic systems that trade across equities, commodities, and digital assets will outperform siloed ones. The hedge funds that will dominate the next decade will be those that successfully build agentic AI systems capable of continuous learning and autonomous decision making. The competitive advantage of this capability is so substantial that funds without it face existential pressure. Steve Cohen's Point 72 earned $3.4 billion in 2025, partly by recognizing early that AI infrastructure would be where exceptional returns could be generated. Other elite managers are making similar bets. The age of hedge funds as pure human intelligence operations is ending. The future belongs to funds that combine artificial intelligence sophistication with human judgment and oversight, creating investment machines that see patterns humans cannot recognize and adapt to market conditions faster than human traders can respond.